So, Bank of America just dropped this absolutely massive forecast. And honestly, it sent total shockwaves through the financial world. They're projecting that by 2026, global semiconductor revenue is going to hit, get this, $1.3 trillion, trillion with a T. That's actually a $300 billion upward revision from just a few months prior, and it's driven almost entirely by this explosive, literally insatiable demand for AI infrastructure. Now, when you hear a gigantic number like $1.3 trillion, your first instinct is probably to think of the household names, right? NVIDIA, AMD, TSMC. But there's a much deeper, kind of more fascinating mystery here. Who actually controls the physical gates to all this wealth? Like, how is it even possible that one single company holds the absolute bottleneck to this entire technological roadmap? Well, welcome to The Explainer. I am super excited to guide you through today's deep dive because we are unpacking what I like to call the ASML paradox. We're going to look at a company that is executing with just absolute operational perfection. I mean, they hold a literal monopoly on the future of computing. And yet, top quantitative analysts are slapping a big red avoid rating on their stock. So how on earth can a flawless company be a dangerous investment? Let's figure it out. Section 1, the trillion-dollar boom and the tech monopoly. Let's dive right into this. Okay, so to really grasp the financial numbers we're going to get into later, we first have to understand the physical reality of what this company actually builds. We're talking about the TwinScan NXE. This is ASML's extreme ultraviolet, or EUV lithography machine. And it is literally the only machine in the world capable of printing the incredibly microscopic transistors that you need for the most advanced AI chips. It is an absolute marvel of engineering, built from a global supply chain of over 5,000 distinct components. I mean, the thing is so complex that ASML's only real historical competitor, Nikon, just threw in the towel. They completely exited the EUV race. Today, there's no Chinese alternative, no Korean alternative, none. If you want to build a cutting-edge chip at 7 nanometers or below, you have to buy this exact machine from ASML. Oh, and their newest version, the High-NA system, it costs upwards of 350 million euros per unit. To put that in perspective, a single machine is more expensive than a commercial airliner. Just wild. So how do you even build a monopoly like that? Well, you essentially bury the competition under a mountain of research and development. Just think about this compounding growth. Back in 2012, they were spending a very respectable $758 million on R&D. But flash forward to 2022, and it's $3.4 billion. And for the trailing 12 months leading into Q1 2026, it's sitting at a staggering $5.48 billion. Developing this EUV tech took over 17 billion euros in cumulative R&D spread across 30 years. This isn't just a financial moat we're talking about, it's an impenetrable fortress of applied physics. The crucial takeaway here is that the operational bull case for ASML is, for all intents and purposes, bulletproof. They are the sole EUV supplier on the planet, period. Their next-generation high-NA systems are already shipping out to heavyweights like TSMC and Intel, and that brings a massive 75% bump in the average selling price per system. Plus, on top of that, they rake in about 2.5 billion euros every single quarter just in recurring installed base revenues. It's basically this highly lucrative quasi-software-as-a-service model, but for servicing and upgrading hardware. And because of the mind-bending complexity we just talked about, they're completely insulated from direct competition. Moving on to Section 2, Flawless Execution and the Q1 2026 Beats. Okay, so this incredible structural moat, it is translating directly to their bottom line. The Q1 2026 numbers really tell the story. Total net sales came in at 8.8 billion euros, easily beating market consensus. Their gross margin hit 53%, which is right at the top end of their own guidance. And their net income margin was a really healthy 31.4%. They delivered an earnings per share of 7.15 euros. That's a 19% beat against what analysts were expecting. And even with the objective reality of export restrictions affecting their older DUV shipments to China, Chinese fabs are still aggressively buying whatever they are legally allowed to get their hands on. That's providing a massive structural demand buffer that accounts for roughly 20% of ASML's revenue. Because of this overwhelming confirmed customer demand, ASML did something that really delighted the market. They went ahead and raised their full year 2026 revenue guidance to somewhere between 36 and 40 billion euros. They aren't just sitting around anticipating demand, right? They are shipping against locked-in, confirmed purchase orders with multi-year lead times. Basically, the whole operation is just humming along perfectly. Now, what's really interesting about this is where the story takes a sharp turn. If the underlying business is effectively flawless, why are institutional quantitative analysts flashing these bright red warning signs? Let's get into Section 3, the valuation trap. So, a recent report by quantitative analyst Anton Lodny over at AL Capital Advisory basically slapped ASML with a really stark avoid rating. And his report draws this incredibly sharp line between the underlying company and the stock itself. On the one hand, yes, we have an A-plus business. It's a literal EUV monopoly, it has a phenomenal 52% return on equity, and it consistently beats earnings. But on the other hand, we have what quant models view as a really dangerously priced asset. ASML was trading at a trailing price-to-earnings ratio of 54.3x. Even worse, Lodny's discounted cash flow model implies that buying at the current price actually gives you a negative 23% margin of safety. Basically, you are paying a massive premium for absolute perfection. To actually put a number on this danger, the report uses a metric called CVR, or conditional value at risk. Now, don't let the financial jargon intimidate you here. It simply measures the expected average loss in the absolute worst 5% of monthly outcomes. Think of it as a measure of tail risk. ASML's 1-month CVR is sitting at negative 12.9%. What that means is, because the valuation is stretched so incredibly tight right now, if they happen to miss earnings or if there's some random negative shock to the market, the downside drop is going to be extremely steep and sudden. We can see exactly where this tension is coming from in AL Capital's 5-factor quantitative radar. ASML absolutely shines in certain areas. It gets a perfect 5.0 out of 5 for quality and a solid 4.5 for size. I mean, it's a legendary, wildly profitable mega-cap company. But it fails the test spectacularly when it comes to value, scoring an abysmal 2.0 out of 5. The whole profile is totally split. The quality is undeniable, for sure, but the price you're being asked to pay for that quality, it's mathematically unjustifiable to a strict quant. Let's walk through the peer comparison really quick to contextualize that value score. So, ASML is trading at a 54.3x trailing PE. That is a whopping 70% premium compared to its sector median. NVIDIA, the undisputed king of AI chips, is trading at a 33x trailing PE, and they have double the net margins of ASML. Even AMD, which is totally caught up in the AI hype cycle, is trading at a massive 155x multiple, but with only a fraction of ASML's margins. The thing is, when ASML starts looking incredibly expensive, even standing next to TSMC, the very company that buys their machines, the quantitative models are pretty much forced to urge caution. Bringing us to Section 4, Portfolio Fit and the Final Verdict. So how do we actually reconcile this? You've got a company literally guaranteeing the future of AI, paired with a stock that could seriously burn you. Well, the absolutely crucial point I want you to take away from this explainer is just this single sentence. A great company is not always a great stock. According to the AL Capital model, ASML's true intrinsic value sits somewhere between $778 in a worst-case bear scenario up to $1,729 in a best-case bull scenario. When the current stock price is hovering right near the absolute ceiling of that bull case range, the market is demanding total flawless perfection. Any slight delay in ramping up those new high-NOS systems or any tiny dip in bookings, the floor could literally fall right out from under the stock price. I really want to highlight this specific quote from Anton Lodny's personal notes in the report, mostly because it just sums up the risks so beautifully. He notes that while ASML does keep beating estimates, the actual size of those beats has started to shrink a bit. He writes, "The market is not pricing in a miss. That asymmetry is worth respecting." And he hit the nail on the head there. When a stock offers zero margin of safety, literally all the risk is on the downside. Which leaves us with this final, kind of provocative thought to chew on. ASML is undeniably a technological marvel. It is an absolutely irreplaceable gear in the global economy. But as investors, we really have to ask ourselves, is owning a guaranteed piece of the future worth paying literally any price the market demands today? It's this incredibly fascinating tension between breathtaking engineering and cold, hard math. Thank you so much for joining me on this deep dive, and I will see you in the next explainer.